Hi guys, welcome to the Savvy Money Show. Me, host Sean. Today we're looking at what stocks to look into when you're when we have the dip. Of course, everyone has their own favourite stocks, and we'll also be looking at what caused the Nasdaq higher and what caused the dip. So stay tuned for that. And we start with Tesla Maisler. Well, we start by looking at the intrinsic value, which is $323.53. Analyst target value, mean price is $296.77. Year-to-date stock gain is 400%. The total assets versus total liabilities is 1.42. Revenue growth is 3.1%. Operating margin is 4.7%. Net income margin is 1.4%. Levered free cash flow is 3.1%. And is showing a bull flag run. Now we head to Microsoft. Now we have an intrinsic value of 214.83, so it's just below an analyst target value of 232.36. Year-to-date stock gain of 37%. Total assets versus total liabilities of 1.65. Revenue growth of 13.8%. Operating margin of 37%. Net income margin of 31%. Levered free cash flow of 31.6%. Now we go to C Limited. If you remember my video on that when it was $88. If not, this is a reminder. The intrinsic value of 132.06. Analyst target mean price of 169.58. Year to date stock gain of 258%. Total assets versus total liabilities 1.16. Revenue growth of 133.9%. Operating margin of minus 35.5%. Net income margin of minus 39.1%. Levered free cash flow of minus 3.5%. But it is a growth stock that operates in multiple areas. That's why you have the minus margins. Anyway, and don't forget to hit that lovely like button, almost as lovely as me. Helps with the YouTube algorithm and getting the video out to more people. And don't forget to hit that subscribe button if you haven't already. Become part of the Savvy Money Show family. We give each other hints and tips and updates about stocks and shares we talk about on the show. As well as that, you can ask me to look into any share you want, and I don't charge a Discord fee or ask for a Patreon. All I do ask is for you to comment in the box below and hit the like button. Even if you disagree with me, especially if you disagree with me, I like a debate. And if I do something wrong, I want you to call me on it so I can improve the channel. And why not check out the links in the description below? There's lots of others. I've used each one of them myself. I wouldn't give you links if I haven't checked them out myself. If you're looking for a free trading platform which should trade your stocks and shares, you know, you can get a free share worth up to £200 for signing up and depositing a small amount. A free trade only requires a £1 deposit. The others require £100 or dollars, depending on which one you go for. Stake has over 3,500 US stocks on their books, which is the biggest one outside of the US. Whereas Trading 212 It's one of the best and easiest platforms to use. But as I said, I use all three. Anyway, on with the show. Accenture has an intrinsic value of 228.44 and the analyst's target mean price is 228.76. Year to date stock gain of 13%. Total assets versus liabilities 1.89. Revenue growth is 4.4%. Operating margin is 14.7%. Net income margin is 11.1%. Levered free cash flow is 14.6%. And we'll head on to the next one, which is Adobe. Now it has an intrinsic value of 454.81. Analysts target mean price of 439.14. Year to date stock gain of 49%. Total assets against total liabilities ratio of 2.01. Revenue growth of 19.3%. Operating margin of 31.4%. Net income margin of 30.7%. Levered free cash flow of 36.8%. And we head on to Apple. Now, it has an intrinsic value of 86.93. Analyst target mean price of 114.86. Year to date stock gain of 66%. Total assets versus liabilities of 1.29. Revenue growth of 5.7%. Operating margin of 24.5%. Net income margin of 21.3%. And levered free cash flow of 26.2%. Now we go to Amazon, and this is the one most people want to know about. Now I'm going to start a different way and you'll see why at the end. Has levered free cash flow of 8.4%, net income margin of 4.1%, operating margin of 5.2%, revenue growth of 27.7%, total assets versus total liabilities ratio of 1.4, year to date stock gain of 78%, analyst value of $3,668.59. Intrinsic value is $3,131.48. I didn't agree with that, so I calculated the intrinsic value a different way, and doing it a different way come up with 2,374. So basically it would be within that bracket. Now I do own Amazon, for full disclosure, and I have a spreadsheet for intrinsic value. Lately I've been disagreeing with some of them, so I come up with one that calculates it a different way, just so I can get different types of intrinsic values, and I could go with a more conservative way. Now that is my review of stocks to pick up. Now we don't just go and blindly buy into them. I like to buy below the intrinsic value. Just because they dip below that, we don't just buy into them. We want to see some sort of recovery as well, and because these dips could be the start of a full-blown crash. So now we are going to talk about a couple of UK stocks I'm looking for dividend wise. British American Tobacco. Now, on the 30th of September, it pays a dividend of £2.10. So they pay an 8% dividend. I wish I got a £1.16 price, but I think that's a mistake because I've never seen it at that price. Even if you look at the charts, you can't find it at that price. Yeah. Still, this is at a low. If you look at the charts, this is at a low. And you might have had it a few quid cheaper at some point, but not much. Look, over the past 5 years, hasn't really. And I understand what some people are saying, that it's a dying, that because of cigarettes it's dying industry, but they're diversifying. They're not purely staying in cigarettes, although it's an industry where they kind of set the price, and people who do smoke, they make them pay for it. And you know, it's simply Wall Street. It says, I don't always agree with them. So fundamentals look strong. Likes of Kcac and Motley Fool class them as some of the top British shares. You know. Yeah. And I picked up the RGO, so that's why it's not in here. But and I did a video about Boohoo before, and the Hargreaves Lansdowne. Yeah. But it's a 65% dividend payout ratio at 8%. You know, what more do you want? Yeah. Now, people in the UK are saying about not being able to get into the ARK Innovation ETF. Personally, not that bothered. ARK Innovation, yeah, it's done well lately, don't get me wrong, but in my opinion, these four are what you want. Roku, yeah, it's a good one to have, but, and they've even trimmed some of their positions. For instance, Invitae was number 2, and they have upped their Square position. Sold Tesla and used the money to up their Square position. Now, so they're buying Square at a high. They've still got Illumina, same position. I think Illumina is a mistake now. And I'm in CRISPR, I'm in Invitae, I'm in Tesla, a tiny position in Square. In my opinion, you're better off getting fractional shares in them companies, and the rest of them not bothering with. Scottish Mortgage Investment Trust does the same as ARK. Yeah. although it doesn't show you what it holds. If you go and you check it, it has the same companies, and it has 1 or 2 other companies as well. This is for those of you who asked about ARC. Now, that is the reason we can't is because Cathie Woods hasn't signed a form which allows it to be traded in Europe. Now we go to silver and gold companies that could soar. MTA, Metalla Royalty and Streaming Limited. Spoke about this a while ago when it was down here. Because it's a royalty company, it buys the mines and leases it to the company, another company. The company has to have the expense of drilling it, getting the license and everything, and then when they pull the gold or silver out of the mine, they get a percentage of it, but they don't get any of the cost, any of the risk of it. If they don't find anything, you know, don't have any write-offs, I think it's a good way to be. Now, Discovery Metals Corp, another one I spoke about before, and I just think these two could really soar. Now with 5G, this is one hasn't been spoken about much. Ticker symbol VUZI, Vuzix Corporation. I think it can either like fly or go like a dead duck, but I think it's one we should look into anyway. There's Diageo. Again, got Fastly, CrowdStrike, BT. There's talk of them reinstating the 7% dividend, and they're gearing up to fight off a $15 billion takeover. And I think it rallied at last Monday. It's come back down, and you may want to pick some up. It's a good price to hold it anyway. Still, it's your decision. There's also talk about takeover approach for this company, even though there may not be anything coming of it. Now, from when it was 100 or £1 a share, the same person has been buying up a load of it. It's a billionaire, and it hit all the way up to 213, and then he stopped buying for a while, and it's gone back down. Now, you can do with that what you want, and I said we were going to speak about what caused the dip. Right, we have SoftBank. They apparently took options on a lot of NASDAQ stocks, putting it up, and what they're saying is they will have come out of it, causing the dip, and it's come out of, not all of it, but some of the options causing the dip, because when you're having billions of dollars in it, you can move it. At the same time, you have people who are in, like the Tesla and Apple from March, they see running up so much, they see the split, You can see a little bit of shakiness in the share price. You don't want it to suddenly fall down, so they're taking their profits. And all of this causes all this institutional investors who only got in short term, wanting to make a quick profit and trade it, to sell out as well. And all of this combined causes the robo investors to see a sell-off and start selling, and that causes a sell-off in the sector, because they see the whole sector that's run up suddenly selling off. Anyway, I'd like to hear your thoughts on it. Don't forget to comment in the box below. Don't forget to hit the like button, it really does help with the YouTube algorithm. And I'll see you in the next video. Stay safe, stay savvy, stay investing. Goodbye.